By the time the Super Bowl kicks off this Sunday, a major U.S. regional bank is likely to be technically insolvent. They want you watching the halftime show. I want you watching your bank account, because while the media was busy crashing the price of silver to hide a vault heist, Goldman Sachs quietly released a kill list of stocks that are going to zero. You have 48 hours to prepare for the Monday morning slaughter. Let's get to work. They think you are stupid. They truly do. They believe that if they flash a scary headline on a Bloomberg terminal, you will panic. They think that if they get the mainstream financial media to run a coordinated story at the exact same millisecond, you will sell your life savings, dump your portfolio, and run back to the safety of the US dollar. And here is the heartbreaking reality. On Thursday, February 12th, for about 30 minutes, they were right. Ladies and gentlemen, OG John AG here, and today is Saturday, February 14th, 2026. Happy Valentine's Day to the establishment, because today we are breaking up with their narrative. We need to talk about the single greatest coordinated wealth transfer I have seen in my entire career as an ex-investment banker. We are looking at a two-front war. On one side, we have a trillion-dollar wipeout in software stocks that Goldman Sachs is quietly helping their rich clients navigate while you get crushed. On the other side, we have a military-grade psychological operation that just crashed silver from $85 down to $74 to cover a vault heist. If you value your financial future, you need to turn off the noise and look at the data I am about to show you. But before we expose the kill list and the vault drain, do me a favor. If you are tired of the institutions having an unfair advantage, smash that subscribe button and hit the like. Let's force the YouTube algorithm to show this truth to the people who need to see it. Let's start with the blood on the street in the tech sector. While everyone is panicking, Goldman Sachs just released a confidential list of software stocks they recommend their institutional clients buy and sell. They didn't send this to you. They didn't send this to me. Just the elites. And honestly, I think that is disgusting. If you agree that retail deserves a level playing field, put the word UN fair in the comments right now. In the last few weeks, we have witnessed what insiders are calling SaaS copper. Nearly $1 trillion has been wiped from software stocks globally. The iShares software ETF is down 22%, and the year has barely started. Salesforce is down 27% year to date. Intuit is down 34%. Workday is down 30%. This is not a correction, folks. This is a slaughter. And the media is telling you it's just volatility. It is not volatility. It is an unresolvable existential threat called artificial intelligence. UBS is calling this an existential threat. When a Swiss bank uses the word existential, you better believe Wall Street is terrified. The thesis is simple. AI agents can now do what software companies charge you thousands of dollars for. Why pay huge subscription fees when an agent can do it for free? Look at what happened on February 3rd. Anthropic dropped a nuclear bomb on the industry. They released Claude Cowork with a legal plugin. This thing does contract review, NDAs, compliance tracking, everything that Westlaw and LegalZoom charge a fortune for. I used to be a lawyer. I know how expensive that software is. The moment Claude dropped, Thomson Reuters crashed 19% in a single day. LegalZoom collapsed 18%. These companies spent years telling us they were AI beneficiaries, and it turns out they are the victims. But here's where the manipulation comes in. While you are staring at your red portfolio, Goldman Sachs drew a line in the sand. They identified the winners and the losers. The losers are companies that rely on seat compression, Salesforce charges per user. If AI does the work of 3 salespeople, you need fewer seats. Their revenue model is dead. It is like selling diet pills that work so well nobody needs to buy them anymore. But the winners? The winners are the infrastructure. Microsoft, Google, Oracle. Why Oracle? They have a $500 billion revenue backlog because they are becoming the plumbing for AI. Goldman also highlighted a sector nobody is looking at: transportation. Transportation stocks are expected to grow profits by 192% this year because AI makes logistics efficient without replacing the physical trucks. Now, while this tech bloodbath is happening, something even more sinister happened in the precious metals market this week. And this is where the deep dive gets truly dark. On Thursday, silver was flying. It had reclaimed $85. The shorts were bleeding out. And suddenly, out of nowhere, a headline hits the wire. Russia considering return to US dollar. Excuse me, this is the financial equivalent of saying the sun is considering rising in the West. Russia has spent 4 years de-dollarizing. They are part of BRICS pay. Their assets are frozen. The idea that Putin would wake up and go back to the dollar is the most ridiculous piece of fiction ever written. But the algorithms don't understand irony. The high-frequency trading bots saw Russia and US dollar and triggered a massive sell program. In less than 60 seconds, billions of dollars of paper silver were dumped. The price crashed from $85 to $74. Retail investors panic sold their ETFs, and guess what? It was a lie, a total fabrication. Elvira Nabiullina, the head of the Russian central bank, came out and explicitly stated, "We are not participating in talks on the return to the US dollar." So why did they lie? Why did Bloomberg and Reuters run this fake narrative? Because they needed liquidity. They needed you to sell so they could buy. We have the data. We checked the CME Group vault reports for that exact day. While you were panic selling, 2.8 million ounces of physical silver vanished from the COMEX vaults. Gone, withdrawn, loaded onto armored trucks. And who was the biggest buyer? JP Morgan. Out of that 2.8 million ounce drain, 2.44 million ounces came directly out of the JP Morgan vault and went into private storage. This was a heist. They used fake news to smash the price by 10%, and then they used the discount to fill the largest physical order of the year. The registered category at the COMEX, the silver actually available for sale, has dropped to 92.8 million ounces. We are dangerously close to zero. But JP Morgan isn't the only whale. We have received intelligence from the silver guru, David Morgan, that the United States government is about to enter the market. In late 2025, the US officially classified silver as a critical mineral. We have zero strategic stockpile. The Pentagon needs silver for Tomahawk missiles, satellites, and solar arrays. They are realizing they are naked. David Morgan predicts the US government will need to acquire 100 million ounces to build a safety buffer. There are less than 500 million ounces of free float in the entire world. If Uncle Sam steps in to buy 20% of the global inventory, the price doesn't just go up, it breaks the calculator. And they are racing against a clock. What clock? The China clock. We have a date, folks. September 3rd, 2026. In China, this is Victory Day. Intelligence suggests this year the parade won't be military. It will be financial. Sources indicate China is preparing to reveal their true gold and silver reserves to challenge the dollar's hegemony. They have 6 months left to accumulate. This explains the crash. This explains the manipulation. China and the US are in a resource war. They need the price low to buy as much as they can before the September deadline. Every time the media lies to you and crashes the price, the smart money is backing up the truck. So, what is the verdict? What do you do on this Valentine's Day? First, look at your portfolio. If you own seat compression software stocks like Salesforce, Workday, or DocuSign, understand that AI is coming for their lunch. Goldman knows it. Now you know it. Consider rotating into the infrastructure, the cloud, the data centers, the energy. Second, do not let them shake you out of your hard assets. When you see a headline that makes no sense, look at the vaults. If the price is crashing but the physical metal is leaving the vault, it is a lie. It is a sale. You are front-running the Pentagon. You are front-running the People's Bank of China. They bought 2.8 million ounces on Thursday while you were scared. Do not give them another ounce. I have put the full Goldman Sachs buy and sell list in our free community, along with the charts showing the COMEX drain. The link is in the description. Go download it, print it out, and study it. We are entering the final 18 months of this cycle. It is going to be volatile, it is going to be scary, but if you stick to the data and ignore the noise, this is the opportunity of a lifetime. Opening visual, host leans forward, camera zooms in. The background screens shift from silver charts to a dark, ominous graphic of a bank run and a collapsing skyscraper. You think the silver manipulation was the main event? You think a $10 smash in the paper price of a metal was the endgame? Ladies and gentlemen, that was just the distraction. That was the magician waving his left hand, so you wouldn't notice what he was doing with his right hand. And what his right hand is doing right now, as we speak, is preparing to seize the money in your checking account. Welcome back to part 2 of this emergency briefing. I'm OG Jhone AG, and if you are still watching, it means you are one of the few who actually wants to know how the sausage is made. And let me tell you, this sausage is made of your pension, your house, and your freedom. We just covered how they raided the silver vaults. But silver is a tiny market. It's a pimple on the elephant's back. The real problem, the $100 trillion problem, is the bond market and the commercial real estate market. And these two Titanics are colliding right now, this weekend, while you are buying roses and chocolates. I want to talk about zombie towers. I want to talk about the Sunday night slaughter that I believe is coming for a major regional bank within the next 48 hours. And I want to talk about a little clause in the Dodd-Frank Act that turns your hard-earned deposit into their equity. Do me a favor, look at the subscribe button. If it's red, you are vulnerable. Click it, turn on the bell. Because when this news breaks on Sunday night, you need to be the first to know, not the last. Let's look at the commercial real estate market, or as I call it, the ghost town asset class. Yesterday, a deal closed in San Francisco that should have been on the front page of every newspaper in the world. A Class A office tower, 350 California Street, heavily renovated, prime location, sold. In 2019, this building was valued at $300 million. Yesterday, it sold for $60 million. Do the math with me. That is an 80% haircut. That is not a correction. That is a liquidation. That is a fire sale. Now, why does this matter to you in Ohio or Florida or London? I don't own an office tower in San Francisco. You say, no, you don't, but your bank does. Your pension fund does. See, these buildings were bought with debt, massive loans. And who holds those loans? Regional banks. The same banks that hold your checking account. The same banks that process your payroll. When a building loses 80% of its value, the loan is underwater. The collateral is worthless. The bank is technically insolvent. But here is the engaging analysis that the mainstream media won't give you. They are using something I call mark-to-fantasy accounting. The banks are not marking these loans down to zero. They are pretending the building is still worth $300 million. They are pretending the tenants are still paying rent, even though the building is 40% empty. They are extending the loans and pretending everything is fine. It's called extend and pretend. But the pretense ends when the depositors want their money back. And that is exactly what is happening right now. We are seeing a silent run on the banks. Smart money, family offices, hedge funds, the people Goldman Sachs talks to. They are pulling their cash out of regional banks and moving it to too-big-to-fail banks or into treasury bills. They are draining the liquidity. And this brings me to the Sunday night slaughter. I have been analyzing the balance sheets of 3 specific regional banks. I won't name them here because I don't want to get sued, but their tickers are in the private report I uploaded to the community. These banks have a commercial real estate exposure that is 400% of their capital. 400%. If their real estate portfolio drops by just 25%, they are wiped out. And we just saw San Francisco drop by 80%. The math is undeniable. These banks are walking dead. They are zombies. And the FDIC knows it. Why do you think the Federal Reserve held an emergency closed-door meeting yesterday? They didn't release minutes. They didn't hold a press conference. But we know they met, and we know what they talked about. They talked about how to handle the failure of a major regional lender this weekend. Usually, when a bank fails, the FDIC steps in, covers the insured deposits up to $250,000, and sells the rest to JP Morgan. That's the bailout model. But the fund is running low. The FDIC does not have enough money to bail out the entire system, so they are going to switch to the new playbook. The playbook they tested in Cyprus in 2013, the playbook they codified into U.S. law under Title II of the Dodd-Frank Act. It is called the bail-in. I need you to listen to me very carefully right now. This is the most engaging, terrifying reality check of your life. A bail-in means the bank does not get money from the government. The bank gets money from you. When you deposit money in a bank legally, that money is no longer yours. You become an unsecured creditor of the bank. You have an IOU. If the bank goes bust, you are just another creditor standing in line behind the bondholders and the derivatives counterparties. In a bail-in scenario, the bank takes a portion of your deposits, anything over the insured limit, and sometimes even under it, and converts it into equity. They steal your cash and give you worthless stock in the failed bank. They say, "Congratulations, you are now a shareholder. We used your money to save the bank." "But John," you say, "that's illegal." No, it's not. It is the law. It is in the terms and service you clicked agree on without reading. And here is the ultimate trap. The FedCoin Trojan horse. Imagine this scenario. It's Monday morning. You wake up. You check your banking app. It's frozen. You can't log in. You go to the ATM. It says out of service. The news comes on. Regional Bank X has failed due to exposure to commercial real estate. To prevent contagion, the Federal Reserve has paused all withdrawals. Panic. Chaos. People lining up around the block. Then, 48 hours later, the solution is announced. The Federal Reserve says, "Don't worry, your money is safe. We are issuing a new immediate liquidity facility. But to access it, you must open a digital wallet with the Federal Reserve. You must sign up for the new central bank digital currency pilot program. They will offer you 100 cents on the dollar if you convert your frozen bank deposits into FedCoin. It is the ultimate bait and switch. They create the crisis by raising rates and crashing real estate. They execute the pain by freezing your bank. And then they offer the solution, CBDC. Once you are in the CBDC system, they own you. They can track every transaction. They can put expiration dates on your money. They can tell you you can't buy steak, you can't buy ammo, you can't buy silver. Connect the dots, people. Why did they smash silver yesterday? To scare you out of hard assets. Why are they letting real estate collapse? To wipe out the regional banks. Why are they launching FedNow and digital wallets? To catch the money when it flees the banks. It is a pincer movement. They are herding you like cattle into a digital pen. And the scary part, the pension funds are trapped in the middle. I mentioned pensions earlier. Let's do a deep dive there. Most pension funds operate on an assumed return of 7% or 8% per year. If they don't make that, they can't pay you. To get that 8% in a world of low yield, they went heavy into alternative assets. What are alternative assets? Private equity and commercial real estate. They own the very office towers that are going to zero. But because private equity funds don't mark to market every day like the stock market, the pension funds can pretend they haven't lost money yet. They report smooth returns. It is a lie. The moment the liquidity crisis hits, the private equity funds will gate withdrawals. They will tell the pension funds, "Sorry, you can't have your money back." And suddenly, that safe, secure retirement check you were counting on, it gets a haircut. 20%, 30%, maybe more. This is not fear-mongering. This is arithmetic. You cannot mark a portfolio of empty office buildings at 2019 prices forever. Gravity always wins. So what is the reality check? The reality is that we are in the eye of the storm. The silver crash was the first outer band of the hurricane. The real estate collapse is the storm surge. And the bank failures are the 150 miles per hour winds that are about to rip the roof off. You have a choice this weekend. Option A, you can do what the sheep do. Watch the Super Bowl highlights, eat your Valentine's chocolate, and trust that Janet Yellen has your back. Option B, you can take action. What does action look like? Get out of the system. I am not a financial advisor. This is not financial advice. But I personally do not keep more than 1 month of expenses in a regional bank. I move it. Be your own central bank. If you don't hold it, you don't own it. That applies to silver. That applies to gold. That applies to crypto. In a cold wallet, not on an exchange. Watch the bond market, specifically the 10-year Treasury yield. If it spikes above 4.5% or 5% rapidly, it means the bank's collateral is imploding. That is your air raid siren. I have updated the Sunday night watch list in the community. It includes the 3 banks I am watching, the specific real estate trusts REITs that are about to implode, and the step-by-step guide on how to opt out of the banking system legally and safely. Opening visual. The host stands up, walks over to a large digital whiteboard. On it is a complex web of lines connecting regional banks, pension funds, and derivatives. He circles derivatives in red. They think they can hide the body. They think that if they drag the corpse of the economy into the basement and lock the door, you won't smell the rot upstairs. But ladies and gentlemen, the stench is coming through the floorboards. Welcome back to the final, most critical chapter of this emergency briefing. I'm OG Jhone AG. We've covered the tech wipeout, we've covered the silver heist, but those are just the symptoms. Now, we are going to cut open the patient and look at the disease. We need to talk about the quadrillion-dollar bubble. We need to talk about the great rotation that is happening in the dark pools while you are distracted by the Super Bowl ads. And we need to talk about the trapdoor that is about to open under your 401k. If you are not subscribed, fix that right now, because what I am about to show you is the blueprint they are using against you. Let's look at the bond market. The bond market is the truth teller. Stocks can lie, CEOs can lie, but yields don't lie. And right now the bond market is screaming system failure. You see, for the last 2 years, we had an inverted yield curve. That means short-term debt paid more than long-term debt. That is unnatural. It's a guarantee of a recession. But historically, the crash doesn't happen when the curve is inverted. The crash happens when the curve uninverts, when it snaps back. And guess what happened this morning? The curve steepened. The snapback has begun. Why does this matter to you? Because the entire banking system is built on the bet that rates would stay low forever. When rates rose, the bank's collateral, the treasury bonds they hold as safe assets, lost 20%, 30%, 40% of their value. But here is the deep dive reality check that CNBC won't touch. The banks are sitting on $600 billion of unrealized losses. That was the official number last year. Today, in 2026, with the 10-year yield spiking again, my analysis suggests the real number is over $2 trillion. The entire equity of the US banking sector is only about $2.2 trillion. Do the math. $2.2 trillion in equity minus $2 trillion in losses equals 0. The system is insolvent. It is a zombie walking. The only thing keeping it upright is confidence. And confidence is a currency that is hyperinflating away. Now, let's connect this to the derivatives time bomb. Host draws a huge mushroom cloud on the whiteboard labeled derivatives. You've heard of too big to fail, but have you heard of too big to save? The 5 largest US banks sit on a derivatives exposure of over $200 trillion. That is not a typo. $200 trillion. That is twice the GDP of the entire planet. These are bets on interest rates, bets on currencies, bets on the weather. When the bond market breaks, like it is doing right now, these bets go bad. And when they go bad, there is not enough money in the world to bail them out. The FDIC has $120 billion. That is a drop in the ocean. The Federal Reserve can print trillions, but printing trillions into a supply shock creates hyperinflation. So they are trapped. They can't bail out the system without destroying the dollar. And they can't save the dollar without destroying the system. This brings us to the Great Rotation. While the media tells you to buy the dip in Nvidia or chase the latest meme coin, the smart money, the family offices, the sovereign wealth funds are quietly exiting the casino. They are rotating into real assets, not just gold and silver, but farmland, energy infrastructure, water rights, commodities that people need to survive. Why? Because they know the paper wealth era is ending. Look at the Buffett indicator, the total market cap of stocks divided by GDP. It is still near historic highs. It implies that stocks are overvalued by 150%. In a normal market, that would correct by crashing 60%. But they won't let it crash naturally. They will try to inflate it away. They will print money to keep the nominal prices high, while the real value of your portfolio collapses in purchasing power. Your stock goes up 10%, but your grocery bill goes up 20%. You feel richer, but you are getting poorer. It is the money illusion. And this is where the trap comes in, the retirement trap. Most of you have a 401k or an IRA. You have been told to buy and hold. You have been told that stocks always go up in the long run. That advice works in a growing empire. It does not work in a declining one. In the 1970s, the stock market went sideways for 14 years. In real terms, adjusted for inflation, investors lost 70% of their purchasing power. We are entering a lost decade on steroids. But the establishment needs you to stay in the market. They need your liquidity. If the baby boomers and Gen X try to sell their stocks to retire all at once, the market goes to zero. There are no buyers. The millennials and Gen Z don't have the money to buy your bags. So, how do they keep you in? Hope. They pump the AI narrative, as we discussed in part 1, to make you greedy. Fear. They make it difficult to withdraw cash, bank limits, suspicious activity reports. Rules. They change the tax laws. Watch for new legislation in 2026 proposing restrictions on 401k withdrawals for your own safety during market volatility. They are going to lock the doors of the burning theater. So what is the engaging analysis? What is the solution? It is time to become a tactical investor. The days of set it and forget it are over. If you fall asleep at the wheel now, you drive off a cliff. Step 1. The barbell strategy. On one end, you want extreme safety. Short-term U.S. Treasuries. T-bills currently pay 5%. It's risk-free unless the U.S. defaults, in which case nothing matters. It's liquid. It pays you to wait. On the other end, you want asymmetric upside. This is your insurance. Gold, silver, Bitcoin, self-custody. Assets that have no counterparty risk. Assets that soar when faith in the system collapses. Get out of the middle, the corporate bonds, the mediocre stocks, the 60/40ths portfolio. That is the kill zone. Step 2. Watch the reverse repo facility, RRP. This is the plumbing of the financial system. For the last 2 years, the RRP has acted as a buffer, soaking up excess cash. It is now almost empty. When it hits zero, liquidity dries up. The buffer is gone. That is when the volatility explodes. My models predict the RRP hits critical levels in March 2026. Next month. Step 3. The psychological hedge. The hardest part of what is coming isn't financial, it's mental. They are going to use fear to control you. They will try to make you feel isolated. They want you to think you are crazy for preparing. You are not crazy. You are early. When your friends laugh at you for buying silver, let them laugh. When your financial advisor tells you gold is a barbarous relic, smile and nod. History is written by the survivors, and to survive this, you need to be cold, calculated, and detached from the herd. I have updated the crisis playbook in the community. It includes the charts on the RRP drain, the barbell allocation model, and a list of the 5 safest jurisdictions for asset protection. It is free. Knowledge should be free. The establishment has their plan. They have their Great Reset. They have their CBDCs. They have their bail-ins. But we have something they don't have. We have numbers. We have each other. And we have the truth. This is the calm before the storm. The tech crash was the lightning. The silver smash was the thunder. The flood is coming. Build your ark. I want your attention. The establishment is playing for keeps. They played the Russia card to smash silver. They are playing the valuation card to hide the real estate crash. And they are playing the safety card to lure you into CBDCs. Don't fall for it.